The first learning objective is to explain accounts, journals, and ledgers, and how they relate to recording transactions. In addition, common accounts will be described. Remember Chapter 1's method of recording transactions? It works very well for very small companies. But companies usually have hundreds, if not thousands, of accounts, and each account would require a separate column. That many columns would not fit on a computer screen, so we must instead use a double entry accounting system. For example, Amazon would need a revenue account for each product it sells in order to be able to track which products are selling and how profitable those products are. So we're going to learn double entry bookkeeping and accounting. So instead of Chapter 1's spreadsheet style of recording transactions, we will use something different. We're going to use a journal, a ledger, and then to make sure that our numbers balance, we will occasionally be creating a trial balance. So let's talk about the order of the accounting process. The journal is first. So the first step in the accounting process is to record transactions in the journal. At the bottom of the slide is a journal. Notice it has a debit and a credit column. We will find out later what debits and credits are and when they increase or decrease accounts. For now, the main thing to realize about the journal is it's the first place a transaction is recorded. What order are the transactions recorded in the journal? The journal is a chronological record where these events are recorded. Chronological order means by date. Notice the April 2nd transaction was recorded first, and the April 4th transaction was recorded later. Looking at the April 2nd transaction, notice that the account that was debited, cash, was listed before the account that was credited, which was an account called notes payable. The same thing with the April 4th transaction. Debits are always listed before credits to make the journal easier to read. Also notice that the credit accounts, notes payable, and then cash in the April 4th transaction are indented several spaces. This also makes it easier to read. Back to the big picture, remember recording transactions in the journal is the first step. The second step is the ledger. So after transactions are recorded in the journal, at various intervals, the transactions are posted to the ledger. Posting means transferring the amounts. So the ledger is organized by accounts and contains the balances of each account. So that's critical about the ledger. The ledger contains balances of the different accounts. The journal does not. On the next slide is a photo of two versions of the ledger, the informal T account and the formal 4-column ledger. So here are two images of two different types of ledger. Notice the account is just cash. So in the ledger, there will be a section for the cash account, the accounts receivable account, the accounts payable account, etc. So an important difference between the journal is the journal has no balances, but the ledger does have balances. So on this slide, we are looking at two different versions of the ledger. Both show the same cash account for the same company. The informal T account version is used for learning accounting. The formal 4-column version of the ledger is what you would use on the job. Again, you don't need to know what debits and credits mean yet, but you should be able to understand the balance column. Looking at the formal 4-column version of the ledger, What is the latest balance of the cash account? The latest balance is $12,200 on December 28th. In the upper left corner is the informal T account version of the ledger. It's called a T account because it kind of looks like a T. T account versions of the ledger are less work than the formal 4-column version of the ledger, so the T account version is used a lot when learning accounting. Plus, they take up less room. Looking at the T account version of the cash account, can you determine its most current balance? BAL stands for balance. So the balance is $12,200, same as with a 4-column ledger. So we're going to be using the T account version of the ledger way more than the 4-column ledger, but don't forget about the 4-column version. So remember, the ledger is organized by account and contains a separate section for each account. So this is a visual representation of a ledger. Again, just remember that it's broken up into sections, one section for each account a company has. For example, many companies have multiple revenue accounts. For example, Target would have a separate revenue account for each product that they sold in order to be able to track which items are selling and which items are profitable. So now let's talk about a ledger, the whole ledger, in the form of T accounts. So this is a view of all the accounts in a company's ledger. Notice at the top we have the accounting equation, assets equals liabilities plus equity. Under equity we have the items that affect equity. We've got revenues, expenses, draws, and then the capital account. So looking at these T accounts, can you answer the most common question that accountants and bookkeepers get? The most common question they get is, hey, how much cash do we have? So how much cash does this company have? BAL stands for balance, so they have $12,200 of cash. Same as the T account and the ledger shown in a previous slide. How much do customers owe this company? So which account shows how much customers owe the company? Well, that's accounts receivable, and the balance is $1,000. So customers owe this company $1,000. How much debt does this company have? Remember, debt is liabilities. How many liabilities they have? They got 4 liabilities: accounts payable, utilities payable, unearned revenue, which we'll define later, and notes payable. So it looks like they owe $60,000 plus $600 plus $100 plus $200. The third step of the accounting process is to prepare a trial balance. The trial balance is simply a listing of all the accounts and their amounts to make sure that debits equal credits. Again, we'll learn later what debits and credits are, including why it's important that they balance. All of these steps and terms will be explained later in future videos. On the next slide, we're going to look at a picture of a trial balance. So a trial balance is just a listing of all the accounts a company has, as long as they have a balance, and then you would also list their balances. Now, the trial balance is not a financial statement like a balance sheet. Only accountants use a trial balance, while many people might read a company's balance sheet to see if they want to invest in the company or if they're a potential creditor to let that company buy on account. Now, some students confuse a trial balance with a balance sheet. A trial balance is not the same as a balance sheet. Do you remember what the formula is for the balance sheet? Well, it's the accounting equation. So the balance sheet only shows assets equals liabilities plus owner's equity. It does not include revenues, expenses, and draws. The trial balance does show all of the accounts, so the trial balance also includes revenues, expenses, and draws. So here's one last overview of the accounting process. We'll be spending so much time in the journal that it's easy to forget this three-step process. So there's some major differences between the journal ledger and the trial balance. If you want to see a particular transaction, where would you look? You would look in the journal. The journal has all the transactions in order by date. If you wanted to look at the activity of a particular account, like cash, where would you go? You would go to the ledger, because the ledger is split up into different sections by account. Now you could technically go into the journal and look at all the transactions and find the many different transactions that have cash included in it, but that would be way too cumbersome. And where would you go if you wanted to see a balance of an account? Well, both the ledger and the trial balance have balances. The journal does not have account balances. So that's critical to know about the journal. The journal does not have balances, and its journal is just a list of all the transactions. The ledger is split up by each account, and inside that each account section, there would be a list of the transactions just for that account and their balances. And the trial balance is just a tool that accountants use to make sure that everything balances. In other words, they use it to make sure that debits equal credits.